What's going on, YouTube? Welcome back to Pocket Change. I got a good video for you. This is the bear market survival guide, and what we're going over is 7 steps to help you in the bear market during the ups and downs to hold on to your money. So starting with step 1, the definition of the bear market. That's what we're stepping with. The bear market is 20% or lower. So when the indice falls 20% or more, that's a bear market. Now, a lot of times in history, it falls at 20%. They don't call it a bear market. It comes out at 19%. They don't call it a bear market. Okay, 20%. And it's happened multiple times that it's done that. And historically, since 1928, there's been 27 bear markets, and the average is 35%. So the 35% decline on average, that's not so bad. If you're a crypto investor, if you've been in stocks anytime, more than 3-4 years, you know that it can easily fall 40-50%. Now, the duration for the bear market usually lasts around 9.6 months. All right. Now, this is the S&P 500. If you're holding on to meme stocks, if you're holding on to Tesla and all these other stocks, it's jumping up and down 35% like nothing. NVDA just went up 24% in one day. So just understand that. That's what happens in the bear market, though. You go down around 35% per day. Not per day, but you can go down 35%. Now, the difference between a bull market and a bear market is the optimism and the pessimism, right? In the bull market, everybody's happy. We're going up 20% every other day. There might be 20% falls, but there's 20% rises right behind it. And that's what happens in the bull market. In the bear market, there's pessimism, right? People are very scared. And so not only is it scary in the fundamentals and the evaluations, and it looks scary in the chart, but people emotionally are very scared, and they're, everything is scaring them. The news, their friends, their family. It seems like you have less money, when everybody around you has less money, you feel like you have less money, right? So strategies for long-term investors: embrace the dollar cost average. Embrace it. It should be something that you stick by, because dollar cost averaging ensures that you are steadily growing your money at a good rate, and you are focused on that. And as you can see here, focus on diversifying your portfolio, mixed stocks, right? Now, I don't care for bonds. If you're a bond person, hey, great for you. All right. So if you would invested $10,000 into S&P 500 since 2003, and that's 20 years, your $10,000 would now be $64,000 despite the up and downs. Okay. The CAGR is around 9.5. So you would have made money regardless of the bear or the bull market. So staying in the market is absolutely important. So just know that. Step 3, navigating crypto bear market. Okay. For you crypto lovers, I'm a crypto person too. I invest in Bitcoin, I invest in other stuff, right? Crypto bear market can see a decline of 80%. So just know that 80% basically of your coin can go away just like that. So diversifying your coins with stable coins, as you start to get that feeling as we're going up, you make sure you put money aside if that's what you're going to do in crypto. For me in crypto, I dollar cost average. So I'm dollar cost averaging into stuff that I know that will be there for the next few years, but anything can change. In crypto, especially, anything can change. So just know that whatever you're putting your money in is not guaranteed. But crypto in the long run, I think, is going to be just fine. Bitcoin dropped 85% during 2018 crypto bear market, from 19,000 down to $3,000, but it recovered over 60,000 by 2021. That's a gain of 1,700%. So Bitcoin also gets hit by the bear market, but as you can see, it gets hit a lot harder. Okay. So the average bear market, 35% decline, and it lasts about 349 days. All right. Guidance for beginner investors. Okay. Make sure you guys have an emergency fund. Make sure you're putting money away when the market starts to get crazy. You don't need to sell at the top. You don't need to always be like, oh, I'm going to sell at the top and make this money. No, 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 no. Just dollar cost average. That's all you need to do. Dollar cost average. You'll be just fine. Missing the 10 best days in the market over 20 years period can cut your total return by more than 50%. All right. So you missing those days can cut your returns by so much money. It's not worth it, right? It's not worth it. So dollar cost average, just stay in the market, put your money in the market. In the long run, you'll be just fine. Just remember that. Risk management, protecting your money, okay? Diversifying these right here, there's 11 sectors in the market, and diversifying is something that a lot of people do. I don't diversify as much as some other people do, and that's just fine. This is how I like my market. How I like my portfolio. I prefer more risk. I prefer to embrace the bear market. When my account goes down, it makes me feel good because I know that I'm getting my favorite stocks on sale. But for others, it may make you feel bad. And if it does, maybe you need to diversify your account, okay? In 2008, while the S&P 500 fell 38%, sectors like consumer staples fell much less, 15 to 20%, showing the value of defense diversification. And as you know that when the market fell not too long ago, Bitcoin didn't even Bitcoin didn't even sneeze at it, right? NVDA, Tesla, all these stocks, my favorite stocks, all of them falling. But you know what held up was Bitcoin. So just know that diversifying in itself is defense. You don't got to sell at the top and keep trying to buy and try to juggle. You're going to lose that way. I'm telling you, you're going to lose. You're going to lose. Let's jump into the next one. The psychology, resilience in the bear market. Okay. You guys have to have resilience in the bear market. This right here is just a chart of it goes hope, optimism, belief, thrill, euphoria, complacency, anxiety, denial, and panic, capitulation, anger, depression. So these are the market emotions, and you need to realize that you can easily get caught up in this, but you have to understand this is emotional. You don't want to be emotional. So I believe we're somewhere up here, right? We're getting there. We might be right here. You know what I'm saying? We're getting up there, but you gotta understand when we come back down, we may pass down your area of interest, your area of entering that stock. So be mindful about what you're investing in as we get higher and higher. That's why dollar cost averaging is so important. Okay, roughly 70% of investors who panic sold during the 2008 financial crisis underperformed the market by 20% over the next 10 years. Okay, so panic selling will kill your account. You know, it's a horrible feeling when you get that scariness and you just got to get out the market and you just got to go. And I understand, and I've done that before, but you do not want to panic sell. That is something that will cost you in the long run. Okay. So now what we're going to do is we're going to jump to the next one. Step 7, conclusion. Preparing today for tomorrow's opportunity is important. All right. It's very important. The bear market is an opportunity for you to make money, to turn your portfolio around, to average down. Okay. You have to be strategic about it. Implementing sound strategies can mitigate risk and positions you have in the future gains. All right. So you doing the wrong moves, trying to avoid the bear market can totally hurt your portfolio in the long run. Okay. So just understand that since 1950, after every bear market, the S&P 500 has fully recovered and moved to new all times high. That's 100% recovery rate so far. All right. So far, the S&P 500 always bounces back. So I hope you guys like this information. It was jam-packed full of statistics and facts. And I want you guys to know my main strategy. We dollar cost average. When the market falls, we double our dollar cost average. Okay. So just remember that. And I want you guys to hit the like and subscribe and come back for more information in the future. We'll get this money together, all right? Let's do this.